Hey, what's up, guys? Welcome back. Joe Brunsman, insurance broker to the stars. I've had a bunch of MSPs reaching out to me in the private MSP groups I'm in. I've had them reaching out to me on, Tech Tribe and a bunch of other places, and they're asking, "Hey, what can we do about this increase in insurance costs? Where is this headed?" And I thought I would just make a video for the MSP community at large to talk about this. So let's go ahead and jump on into it. Now, if you've been keeping track of your Tech E&O policy, you've had it for a while. You will see that, yes, it has been getting more and more expensive. Now, the percentage range there is in blue, the trend line is in orange, but the gist of it is, yes, it has been getting more expensive. Now, from the USI Market Outlook, what you're seeing here is pretty much what was reflected on the previous slide, and that is 2021, we saw 35 to 50% increases for optimal risks, and 2022 to year end is going to be 40 to 50% for optimal risks. Now, that's just Tech E&O in general. I have seen smaller increases on the MSP side, but nonetheless, that's just kind of where it goes. Now, I want to give you guys a quick background on how insurance works, and that is going to make this much easier to understand moving forward. So in a quick 30 seconds, let's talk about how to get rich like Warren Buffett. So in the insurance industry, it's all based on something called the float, and that is premiums collected minus the claims paid or what they pay out, right? Warren Buffett has said, hey, this collect now, pay later model leaves us holding large sums. And then what do insurance companies do with those sums? Well, they invest it in stocks, bonds, other securities, short-term investments, that type of thing, to try and generate a rate of return. Now, obviously, that does not always go as planned. There are things that would just be entirely outside of your control that would lead to an increase in insurance. So that's just not only your Tech E&O insurance, but that could also be all the other types of insurance that you hold. Number one, big natural disasters. We will see a giant surge in insurance claims. Probably the easiest example here is going to be the hurricane that ripped through Florida. Thankfully, I actually escaped that like 6 hours before they shut down the airport. I was giving a talk down there. But suffice to say, insurance companies lose a bunch of money. They suddenly have to pay out enormous amounts of claims. That's going to increase the cost of insurance for even people not associated with that claim. Next, we're going to see economic recessions. Why? Well, claims are more likely when people are struggling. And I'll show you an example of that in a different industry here in a second. But that makes sense, right? Something where maybe in good times, a company would have brushed off that $10,000 or whatever because they're like, it's not worth my time. Suddenly money's a lot more tight and they're going, oh no, I'm not going to be out 10 grand because of XYZ. I'm definitely bringing a claim for that. We're also going to see specific class risks. So as far as like cyber and Tech E&O goes, ransomware, business email compromise, data breaches, increasing threat and cost of litigation against MSPs. Obviously, that's going to drive it up. And then inflation. So just think about it this way. If you're an insurance company and we have, I will be generous here and say 8% inflation to go along with the Fed, or 9, whatever it is now. It's probably potentially double that if you've been to the grocery store recently. Just to break even, what would they have to do next year at renewal? They would have to bake that inflation in. All right. So that's just kind of how it goes, unfortunately. Now, this is an example of E&O claims versus the S&P 500. This is from a book I wrote way back in like 2016. Yeah, 2016, when I first joined the insurance industry. Now, this is FINRA arbitration filings versus the S&P 500. So in the light gray, you will see the S&P 500 yearly openings. And then in the black, you will see FINRA arbitration filings. And look, that is just damn near a perfect mirror image of each other. All right, so suffice to say, like, it's just times get good, people are less likely to sue. Times go down, people are more likely to sue and bring a claim. And just look what's happening to the stock market right now. It's going down. People are much more likely to bring a claim. We've got crazy inflation. Arguably, there's some questions there about stagflation, but I'll leave that to an economist to answer that. But it's just right in front of you there. All right. The other thing you have to think about is loss ratio. Okay. And stick with me because this is going to be important. So I'll give you an example. Let's say an insurance company earns $10 million worth of premiums, and then they pay out $6 million in claims and another $500,000 in adjusting claims. Their loss ratio is 10 million over 6.5 times 100, which is 65%. All right, that is their loss ratio as a percentage. Now that is bad. You think that they just earned all this money, but oh no, there's more to the story. Don't forget, these insurance companies, they're big. There's a lot of lawyers in there. There's a lot of underwriters. There's marketing. There's salaries. There's utilities. They have to pay their own reinsurance costs. There's way more to it. So an acceptable loss ratio, really 40%. Once you get up to 60%, like that's really, you'd have to be looking at like a bare bones operation to be profitable at a 60% loss ratio. Okay, so let's look at who's probably losing money on cyber insurance. Now, 2022 numbers are not yet in. These are 2021 numbers. And you'll see highlighted in yellow there, that's the loss ratio column. There's market share to the right. And then anybody over 40%, I just highlighted them. So if you're American International Group and you have a loss ratio of 130.6%, and getting up to anything over 60% or arguably 40% is probably bad. Just imagine the amount of money that these guys are losing. It's brutal. An absolute brutal bloodletting of cash over there. Now you'll look at somebody like Beasley Group right here in the middle. And as of 2021, according to this study, they were 38.7%. Now that's interesting because I can specifically tell you that Beasley has cut off entire industries. They have cut off specific industries or specific revenue thresholds. And so that's probably how they're stemming the bleeding. But even those guys, you're like, okay, they might just be barely profitable at 38.7. And now we've got guys at 130, 105, 95, 80, 69. The numbers are just right in front of you. These guys are losing money. Now, as MSPs, I would argue you guys get hit with what I call the quadruple whammy as far as insurance goes. As we talked about before, hey, E&O claims are much more likely when the market goes down, so that's going to affect you. Next, arguably cyber claims are going up in both frequency and severity. Now, there's a little bit of wiggle room there, but I think the preponderance of studies are saying, hey, the claims are going up, the frequency is going up, the severity of these claims is going up. So that's going to affect both you and your clients. Now, obviously, you're easy to blame when a cyber loss occurs at one of your clients, so that would implicate your Tech E&O policy. And the kicker of all of this is effectively your Tech E&O policy is both an E&O and a cyber policy squished together for reasons which I will spare you from here, but you're kind of getting hit from both sides. Now, insurance companies, I was actually talking to an underwriter yesterday, and I promised I wouldn't use his name. I'm not going to tell you who the insurance company is. But I asked him because they don't do Tech E&O for MSPs anymore. And I was like, why don't you guys do that? And here's what he said. He goes, hey, we don't mind MSPs going into client infrastructure. We're terrified of the constant monitoring aspect. We think that the MSP is seen as the last line of defense for any type of cyber event. And incidentally, they're also then first in line for a claim. The loss ratio that they had on those guys was allegedly awful / really bad. So that doesn't help the case. And they also said their claim size and the frequency are much too high and lots of limit losses, which means this insurance underwriter was saying, we had way too many cases where the MSP got hit with a claim and we were literally just writing a check for the entire limit of that policy, right? No defense, no going to court. I've talked about why it's very hard to defend your MSP in court earlier if you go back to some of my other videos. But it's just very hard, so these guys are just writing big checks. And they got very tired of doing that, so then they just decided to completely stop offering Tech E&O to MSPs altogether. Now, I did ask him, would it change your mind if all these MSPs started contractually requiring their clients to carry cyber insurance? And his point was requiring them to carry cyber insurance would make them more appealing. Now, it's not his decision, but he goes, yeah, that would actually make a lot of sense and would generally probably alleviate a lot of what we have going on, or at least minimize or lower a lot of the losses that we're seeing in that particular area. Now, I wanted to give you guys an example of, say, what one of your peers could be paying for their insurance policy versus what you guys could be paying for your insurance policy. So I just use CPA firms because I have tons of CPA firm clients and it's easy for me to look up that data. Now, a CPA firm, they can expect, this is an SMB CPA firm, probably a big claim about every 20 years. There's very established case law. They have state societies. They have a national lobbying group called the AICPA, which is actually international now. There's a whole bunch of case law behind it. The courts are very adept at handling these types of cases, but it is obviously very complex, just like an MSP, because we're talking about a tax code that's over 75,000 pages or something now. So it is very complex, but what can they pay for E&O? For about $1 million in coverage, the rough idea there is about 0.5% of gross revenues. For $1 million cyber policy, they're right now paying about 0.2% of gross revenues. So the total between those is about 0.7% of gross revenues for both of those policies combined. Now, we look at MSPs and we go, okay, we have unknown claim frequency, at least according to the previous underwriter, limit losses, the loss ratio is terrible, all sorts of other, unclear legal standards, lots of questions on who's ultimately to blame if somebody clicks on the wrong thing, right? Is there partially it's the client's to blame and you're to blame? A lot of ambiguity there. So for $1 million in Tech E&O, I've seen anywhere between, say, roughly 0.3% to 0.5% of gross revenue. And keep in mind, that is effectively for both an E&O and a cyber policy squished together. Now, it's not a perfect comparison. I understand that. But what I'm trying to say here is, compared to your peers in other white-collar professions, I would argue that generally you are still much below market average for what we would expect. So what does that mean for you? That means that, unfortunately, I expect that these premiums are only going to go up for the foreseeable future. Now, what are some strategies to help you? I promised that I would, at the beginning of this video, I was going to give you guys some strategies to help you. Here are the few things I think you need to know. Now, one, this is going to sound weird. Please stop renewing in December or January. It's a huge pain. Why is that? Well, about 40% of insurance renewals occur during this time, right? During that January 1 date, which means we got to, back it up, and you've got Christmas and you got New Year's. Underwriters obviously want to spend time with their families. It just puts you in this insurance churn, right? And for an MSP, what you guys do is very technical. And there's a lot more back and forth with an MSP quote as compared to, say, a CPA firm or an architect and engineer, because the underwriters are much less comfortable with MSPs and there's a lot more scrutiny there. So you want to get out of the December, January cycle if at all possible. That is going to help you out, and you can make your case why you're a better risk, because if you're in December or January renewals, the probability the underwriter is going to pay attention to you is almost zero. They're churning and burning as fast as they can. Whereas if we get out of that date, much more likely that they will have that little bit more spare time there where they can actually adjudicate that request, as I'll put it. Also, you're probably really busy too. I'm super busy during that time. It just makes everything harder. So if you can, see if you can ask for a hard extension. That will actually move your renewal date. Try and get the longest one you can just to get out of that December or January timeframe so that you can make the case to the underwriter and avoid just getting squished with something that you don't want and you don't have time to fix. That's not to say that an insurance company will let you do that, but if you're just hey, we're trying to get away from December or January, generally underwriters are pretty okay with that because they don't like those 2 months either. Now, when you're looking at your application, here's a fun fact. It's going to be asking for revenue, and all this boils down to gross weighted revenue. All right, so you're going to see last year, you're going to have current year or this year, and they're going to have next year referred to as estimated or projected. Now, within that, they then weigh those. So it could be 30, 40, 30, last year, this year, next year. It could be, I don't know, 30, 20, 50. It just depends on the insurance company in their particular rate filings. But the important part here is your premium equals rate times gross weighted revenue. So the premium, that's how much you're going to pay, equals your rate, effectively a number that pops out based upon all the questions you answer and how you answer them, times gross weighted revenue. So why is that important to know? Because if you drastically overestimate what you're going to be charging next year or what's going to be coming in the door for gross revenue, you are effectively just throwing money out the door. All right. So I would encourage you here, be truthful, but conservative. This is a projection. It's an estimation. Nobody has any idea what next year is going to bring. If I would have gone back to say like 2018 and would have said the same thing, you'd probably been like, what are the odds that, I don't know, this world-changing virus would come along and everything would get shut down and et cetera, right? So you see the point there. Please do not overestimate future revenues that will materially and adversely impact your premium. Now, what have I seen asked about? What are some things that you can try and do beforehand? Nothing here is super magical, but I've seen security awareness training, internal MFA for email accounts, remote access, any user with admin or privileged access, written data breach response plans, written disaster recovery and business continuity plans. Is it kind of silly that an underwriter wants a breach response plan from an MSP? Generally, I'm going to say you guys are much more adept than the average business on how to respond to an event, at least those immediate action steps. But nonetheless, it's worth just having that in place so that way you can shop the market and you're not going to run into that problem. And then next, just have two-person integrity on any wire transfers, ACH, etc. What do I mean by that? It's before money goes out the door, if you're going to send it electronically, you want to make sure at least two people are checking, hey, is this the right bank account? Is there something fishy going on here? Maybe we need a prearranged callback number, that type of thing. That will assist you on the application as well. All right, next, please get offensive. I've put out a whole bunch of material on this, but things like Get Smart, Defense in Depth for your MSP, that's all about risk management, risk transference, a discussion on liability waivers. I've talked about limitation of liability in contracts. I've talked about contractually requiring your clients to carry cyber insurance. I think that's one of the single greatest risk transference mechanisms you can put in place. Because if we just go back to that underwriter, what was he saying? He's like, hey, we don't want our insurance policy to be a piggy bank for every time an end user does something dumb. And that's what he sees as happening in the past. So that's why they don't offer Tech E&O to MSPs anymore. And if you don't believe me, just go to Watch Before Disaster. That is an actual court case against an MSP after a $1.7 million social engineering claim. And you can just see what the actual allegations were there. Compare that to my video, Get Smart, that I put out before. And you can just look hand in hand to see if you want to implement those particular measures. Now, I understand that insurance is expensive. For whatever it's worth, man, my insurance is going up too. All right. So there's no such thing as a free lunch here. I am in the same boat that you guys are. And for whatever it's worth, I pay more in insurance as a percentage of gross revenue than you guys generally currently are at this time. So there is an appeal, I understand, to get a cheaper policy. Okay. One, trying to switch mid-policy period probably is not going to happen. I mean, we can try, or you can try, but they're not really digging that. So please make sure you have the right Tech E&O policy. All right. If you think that Tech E&O insurance is expensive now, man, try paying for that claim with no insurance at all. Or if you have the wrong insurance and it's not actually covering what you think it should have covered, you are going to be in for a bad time. So if what you're paying is drastically cheaper than what your buddies are paying, something there is wrong. All right. There's no free lunches here. So here's an example for you. This was computer consultant. You'll see their miscellaneous E&O policy. In this example, that was the wrong policy. Here's another one. Computer consultant, management consultant, telecommunications consultant, staffing services. If you dig into the policy, This was not covering what an MSP was doing. Next, here's another one. Computer consultant or technology consultant. Now you'll see right in front of you here, there's just a list of things, right? And if you are not operating exclusively within that list, there's a high probability that when a claim arises as an MSP, you will be denied either full or partial coverage on that claim. And then that is going to be awful, stressful, and way more expensive than it otherwise should have been. Okay? So you, somewhat counterintuitively, you don't just want a list of things that it's going to cover you for. What you want is something like this. So you'll see this example here, technology services and internet services for others for a fee. And then you dig into that and you go, okay, what's technology services? IT services performed by and insured for others, including but not limited to. And that is the most important phrase there. So in insurance law and contract law, there's a term called contra proferentum. And what that means is ambiguity is held against the draftsman. So in this case, the insurance company is the draftsman. So when they put that type of language in there, they're signaling to the courts. Now they're signaling to you. They're signaling to, well, insurance people should know this, but generally they don't. But they should be signaling to the insurance guy. They're saying, hey, we can't possibly list everything that could be construed as an IT service. So unless it's just A, specifically excluded, or B, it's so far outside the bounds of what a reasonable person would assume an IT service is, very, very high probability they're going to have to cover that claim for you. And then you'll see internet services, and at the bottom here, if I just move my head, you'll see technology products. If you're a value-added reseller of hardware, that's good to have there as well. All right, so moving forward, what do I want you guys to know? Man, just keep in mind, we're all in this together. I'm paying way more for my insurance. You guys are paying more. That being said, if you can avoid a claim, if you can avoid a cyber event, that is going to pay dividends for years to come down the road. So please take your own advice on security, take a step back, get your team in the room and say, okay, what do we need to do internally, not only to look better on an insurance application, but also to try and avoid a cyber event or some type of E&O claim against our business. Make sure you're increasing your rates accordingly. I put out a video about this earlier, but the gist of it is, you know, all of your peers in other professions, the cost of insurance is just kind of baked into the cake. All right. And I understand it's painful now because you guys have seen this quick, drastic rise, but arguably it was severely under premium for many, many years in the past. So you guys are kind of just getting what generally would have taken an industry like 20 years to get up to. You guys are doing it in like 2 years. And it sucks and it's painful, but it's just got to get baked into the cake, because if you don't have insurance, one, you're going to have problems getting contracts. And two, if something is to occur, man, that could just put you out of business. And that is not a good place to be. So please think long term here. Not all is bad. Now, as humans, we tend to think just in a linear fashion. And so we're like, what's going up will always go up, but what goes up must come down. So there could be some world-changing event where next year insurance actually gets cheaper. We just don't know. Now, I don't think that's going to happen, but I am not the be-all, know-all of the insurance industry as a whole, right? I know a whole lot about a very, very little part of insurance. And so with that being said, just think long-term, all right? This too shall pass. Eventually, the rates are going to even out. Eventually, other insurance companies are going to come back into the mix, and they're going to try and lower those rates. There's going to be more competition. All that eventually will happen. We go hard market, soft market, hard market, soft market. It's just a sinusoidal process. So maybe 10 years from now, you're going to see the same thing happen again. And then 13 years from now, the rates will go back down to where they were 10 years from now, and so forth and so on. All right. Probably the best news that I can leave you guys here with is please watch a video. I'll link to it here in a second. But cyber insurance, those guys are going to be your best sales partner moving forward. So at least you have that going for you, which is good. To quote Bill Murray, if anybody here is a Caddyshack fan. So, you know, just keep in mind, your clients are also going to be subject to this. They're also going to be subject to increasing requirements and higher rates and that type of thing. So that is going to drive increasingly more business to your MSP, generating additional revenue for you. So hopefully some of this will kind of even out for you. All right, with that, that's the video that I'll link to right above. If you look over there and you click on my beautiful face, you can subscribe to my channel. Please like, share, comment, subscribe. Tell me if you think I'm just way off base and I'm out to lunch on this one. Otherwise, hope you guys enjoyed this. Stay safe.